Hey everyone, welcome back. You ready to get deep? Today, we're going to tackle the Wyckoff Method.
Ooh, yeah. Classic stuff.
We've got some excerpts from Ruben Villahermosa's book
Nice.
to help guide us. But, this is all about understanding how those big players, those market movers,
Yeah.
really influence things. And maybe, just maybe, how we can sort of, get a glimpse into what they're doing and use it to our advantage.
Yeah. It's like learning to see those footprints
Yeah.
that they
Yeah.
leave behind, right? Richard Wyckoff, he was the guy who kind of put this all together like over a century ago. He was really amazing at observing market manipulation and turning it into an edge.
Okay, so let's get into it, right? What's step one? What's the first thing we need to understand about this whole Wyckoff world?
So Wyckoff, he laid down these three fundamental laws
Okay.
that kind of underpin his whole approach. And the first one might surprise you. It's supply and demand.
Supply and demand.
But he took it a step further than just looking at the number of buyers and sellers.
Okay. So what's the twist?
He was really focused on this difference between what are called aggressive orders and passive orders.
Oh, okay.
So an aggressive order, like a market order, is executed right away, whatever the price is. But a passive order, like a limit order, that only gets filled at a specific price or better,
Yeah.
right? So Wyckoff believed that if you could look at the balance between these two types of orders, it could actually reveal the intentions of those big institutions.
Oh, that's interesting. So it's not just about who's buying more,
Right.
but how they're buying. It's like, are they rushing in? Are they
Absolutely.
being patient?
Yeah, the urgency, right?
Yeah. Okay, so I'm thinking, today we have all these algorithms, right?
Right.
Doing high frequency trading.
Yeah.
Could we say that those algorithms are like the new big players in this Wyckoff sense?
That's a really, really interesting question, right? Because algorithms can definitely mimic those actions that Wyckoff was talking about, placing these huge orders super quickly.
Yeah.
And they could definitely move the market.
Yeah.
So it's definitely something to think about in today's environment.
Yeah, for sure. It's changed the game. Okay, so supply and demand, Wyckoff style. That's law number one. What's the second one we got to wrap our heads around?
So law number two, he called it cause and effect.
Okay.
And this is all about understanding the link between like when price moves sideways and then, when we get those big breakouts.
Okay, yeah.
He believed that those sideways periods, that's the cause. And they're actually building up this energy for that eventual breakout trend, which is the effect.
Okay.
It's like that spring analogy, right? The tighter you compress the spring,
Yeah.
the more explosive it's going to be when it releases.
I like that. So, but how did he measure this cause, right?
Right.
To figure out like how big the effect could be.
So he used these things called point and figure charts, which helped him kind of, really visualize and quantify that amount of sideways movement. And based on that, he could then try to project how far the price could move once it broke out of that range.
Yeah.
Now, whether this still works perfectly in today's super fast markets, that's debatable. But the principle, the idea is still
Yeah.
very relevant.
Yeah. Things move so quickly now. All right. So we've got supply and demand with a twist.
Right.
We've got this cause and effect.
Yep.
What's the final law that completes this Wyckoff foundation?
So the third law, he called this effort versus result.
Okay.
And this ties in with those first two laws. Wyckoff basically saw volume as the effort,
Okay.
and then the change in price as the result.
Got it.
And he said that for a healthy trend, those two things need to be in harmony.
So give me an example.
So, for example, if the price is going up and the volume is going up with it, that would indicate a strong buyer conviction.
So if we see a mismatch, right? Like if we see high volume, but the price isn't really moving much, that would be a red flag.
Absolutely. That could be a sign of manipulation, or it could be a sign of weakness.
Yeah.
Something's not quite right there. And here's a cool detail.
Yeah.
Wyckoff, he was so into this, he would actually analyze effort and result even down to the individual waves of price action.
Wow, he was really in the weeds.
Yeah, looking for these subtle harmonies and divergences.
And that's commitment. Okay. So we've laid down the law, right? The Wyckoff law.
Yeah.
Now let's move on to how these big players actually manipulate the market. The book mentioned these phases like accumulation and distribution. Can you break those down for us?
So think of these phases as the playbook
Okay.
that these big institutions use, right? Like how they orchestrate their moves. So accumulation is basically where they start to buy low.
Oh,
They're
yeah.
quietly amassing shares,
Yeah.
and they're doing this within a sideways trading range.
Okay, so that creating that clause that we were just talking about,
Yeah.
setting the stage for a move up.
Exactly. And during this phase, they often do something called shaking out the weak hands.
What is that?
So these are the traders who get spooked easily, right?
Mm.
And they sell at the first sign of trouble. And that allows the big players to buy even more shares at a discount.
Oh, that's clever. Okay, so accumulation is like buying low and setting the trap.
Right.
But what about the flip side? When they want to sell?
That's where distribution comes in. It's like the opposite of accumulation.
Okay.
Now they're selling high, right? But again, they're doing this within a range. They're trying to trick others into buying near the top.
Oh, man. So they're setting the trap in the opposite direction.
Exactly. And Wyckoff, he actually documented specific maneuvers
Wow.
that they used during this phase,
Right.
which just shows how deep his understanding of market psychology was.
That's crazy. Okay. So we've got accumulation for buying low, distribution for selling high. But the book also mentioned these other phases, reaccumulation and redistribution.
You got it.
What are those all about?
So think of reaccumulation and redistribution as kind of like mid-trend pauses.
Oh.
So reaccumulation, that happens during an uptrend.
Yeah.
The big players, they take a break, right? They might shake out some more weak hands, and then they accumulate even more shares
Okay.
before they continue that upward move. Like it's almost like refueling for a bigger journey.
I like that.
And redistribution, that's the same idea, but for a downtrend.
Okay.
So it's a pause to distribute more shares before they continue moving lower.
Got it. Okay. So we've got these 4 phases. They kind of paint the bigger picture.
Right.
But the real action, it happens within those phases, right? The book talked about these specific events
Yes.
that kind of signal shifts in control. Is that where we're headed next?
Yes. You're catching on quickly. These events, they're like tells in a poker game.
Ooh, I like that.
And Wyckoff, he identified several key ones.
Okay.
So the first one is the preliminary stop. This is that initial attempt to stop the prior trend. And it's important to note, this always fails.
Always. Why is that?
Well, think about it like this. The market has inertia, right? If it's been trending down, that first attempt to push it up, it's going to meet resistance from sellers who are still, bearish on that stock.
Makes sense.
So this initial failure sets the stage for the next event, which is the climax. And this is where it gets really interesting.
Okay, this is where we see like the peak of emotion.
Exactly.
High volume, but the price isn't moving much.
Exactly. And the psychology here is fascinating. So you have those people who are panicking. They're selling into the climax. They're basically giving their shares to the pros at a discount.
Right.
And then you have those people buying into the climax thinking the trend is reversed.
Oh, no.
And they're getting in right before the price potentially drops. Classic trap.
So the pros are profiting from the emotional reactions of the other traders. That's kind of devious.
Well, it's all part of the game. Now, after the climax, we get the reaction, which is this significant move in the opposite direction. This signals that the pros, they're now in control, and they're starting to push the price where they want it to go.
Okay, so we've had the false start, the surge of emotions, and now this sharp reversal. What happens next in this Wyckoff saga?
So the next event is the test. This is a weaker move back towards that climax level. Basically, it's the pros checking, right, to see if there's still enough selling pressure to push the price back down. And if you see low volume during a test, that's a very bullish sign. It means those sellers are getting tired.
Low volume during the test. Okay, got it.
Yeah.
So what's next? Is this where the real breakout happens?
Not so fast. Wyckoff, he was famous for identifying this really sneaky event. It's called the shakeout.
Uh-oh, what's the shakeout?
This is a fake breakout.
Yeah.
It's designed to trap traders and create more panic.
Mm-hmm.
So it lets the pros grab even more shares at a discount.
So they make it look like it's breaking out, and then they just slam it back down?
Pretty much. And they have special names for these shakeouts, depending on which direction they're going.
Yeah.
So a spring, that's a bullish shakeout. And then an upthrust after distribution, that's a bearish one.
Okay.
And both of those, they're designed to trigger stop-loss orders, right? People panic, they sell, and the pros get to buy more.
So it's all about capitalizing on those emotional reactions.
Exactly.
Okay, we've got the preliminary stop, the climax, the reaction, the test, and now the infamous shakeout. I'm starting to see how these pieces fit together.
Right.
So once the pros have shaken out all those weak hands, what happens then?
That's when we finally get to the real breakout. This is the move that's confirmed by strong volume
Okay.
and decisive price action.
Mm-hmm.
It's the signal that the pros are ready to ride this trend and take the price where they want it to go.
Finally, the real deal. But even after the breakout, there's one last event, right? Something about confirmation.
You got it. The last event is the confirmation.
Okay.
And this is a weaker pullback after that breakout. And what this does is it confirms that the trend is actually strong.
Okay.
And the pros are still in control. It basically gives those people who missed that initial breakout a chance to jump on board.
Wow. 7 events, each with its own little psychology and purpose. It's like a whole new way to look at the market.
Yeah.
But how do these events fit into those larger phases of accumulation and distribution that we were talking about before? I'm ready to see how it all comes together.
All right, so we're back, diving deeper into Wyckoff.
Yeah, those 7 events. You really had me on the edge of my seat.
Right. It's a whole market drama unfolding.
It is. But, okay, how do we actually put those clues together to see those accumulation and distribution phases in action? Like, how do we spot them?
Okay, so let's try to picture it like a play with 5 acts, right?
All right, 5 acts.
So Act 1, Phase A, it's all about stopping that previous trend.
Okay.
Remember that climactic event we talked about where everyone's going crazy?
Yeah.
That often marks the end of the old trend, and that's the beginning of Phase A. Then you get that automatic reaction and maybe a test. And that kind of confirms, okay, the power is shifting here.
Okay, so that's our opening act.
Yeah.
Setting the stage.
Right.
What happens in Act 2, Phase B?
Phase B is where the real work starts happening.
Yeah.
This is where the big players, they're building the cause. They're either accumulating shares, if we're going to see an uptrend, or they're distributing shares, if it's going to be a downtrend. And you'll often see multiple tests in this phase.
Okay.
And maybe in a shakeout or two. They're trying to absorb or unload a big position without, giving away their secrets.
Right. Sneaky.
And this is where the length of the phase can actually give you a clue.
Oh, really? How so?
So a longer Phase B usually suggests that a bigger move is coming.
Oh, interesting.
Right. Because the longer it takes to accumulate or distribute all those shares, the more energy, that potential energy, is stored up.
Right, like winding up that spring.
Exactly. The more you wind it, the more powerful that release.
I like that. Okay, so long Phase B. Keep an eye on that.
Yep.
What about Phase C? Is that when the trap is sprung?
Phase C, that's the climax of our play. This is where we see that most decisive shakeout.
Okay.
The one that really separates, the pros from everyone else.
Yep.
Remember, those big players, they want to get as many shares as possible at the best price. So they will create this panic right before they reverse direction.
So if you can survive that final shakeout, you're in good company.
That's the idea. You're riding the wave with the big guys.
All right. So then we move on to Phase D. That's where the real breakout happens.
Phase D, breakout time. The new trend starts to take shape. We see confirmation that the pros are in control. The price starts moving in the direction that they want it to go.
And then Phase E, the trend plays out.
Phase E, that's where you bring in all those trend analysis tools.
Okay.
Your moving averages, your trend lines, your momentum indicators. They can help you stay on board for as long as that trend is in your favor.
All right, so those 5 phases paint a pretty clear picture.
Yeah.
But the book also mentioned these things called accumulation distribution failures. What happens there? Like, do the pros ever get it wrong?
They do. Not every attempt at accumulation or distribution leads to a breakout. Sometimes the market throws you a curveball, right? And maybe there's some news or sentiment shifts.
Yeah.
And the big players, they have to abandon their plans.
So it's not foolproof.
No system is foolproof. And that's why Wyckoff always stressed the importance of confirmation. You don't want to jump the gun and think you know what's going to happen. You got to wait for the market to confirm it before you commit to that trade.
Good advice. Okay, the book also talked about analyzing a chart from zero. What does that even mean?
So that means you got to approach the chart with a completely open mind.
Okay.
No biases, no preconceived notions. You're just observing, right?
Yeah.
Looking at the price action, the volume, and letting those Wyckoff patterns emerge organically.
Okay, so no jumping to conclusions.
Yep, just pure observation.
Yeah.
You let the market tell its story, and you're using Wyckoff as that framework to interpret that story. You're looking for those climaxes, the reactions, the shakeouts, all those tells.
It's like being a market detective.
Exactly. And then you start piecing together the puzzle.
Yeah.
Figuring out who's in control.
Yeah, I like that. But the book also mentioned these different types of structures from minor to major. What's that all about?
So that's where things get really interesting. Wyckoff, he believed that markets have this fractal nature,
Okay.
meaning that those patterns, they repeat themselves on different time frames.
Oh, okay.
So what you might see playing out on a daily chart
Mm-hmm.
could also be happening on a weekly or a monthly chart,
Interesting.
just on a bigger scale.
It's like those Russian nesting dolls.
Another great analogy.
Why?
And so by understanding the context from those larger time frames, you can make smarter decisions on those smaller time frames. Like you might spot a minor accumulation phase within a larger accumulation phase.
Oh, wow.
And that can give you even more conviction.
Okay, so they can nest within each other. That's cool.
Yeah.
What about those other types of structures that the book talked about, like structures with a slope
Right.
and extreme weakness structures?
Yeah, so Wyckoff recognized that not all structures are perfectly horizontal.
Okay.
Sometimes you'll see accumulation or distribution happening on an upward or downward slope, which makes it a little trickier to spot.
Right, right.
And then those extreme weakness structures,
Yeah.
those are when the selling is so intense that there's no real accumulation phase. The price just keeps dropping.
Ouch, sounds painful.
Yeah.
And then there were those hypodermic structures or V-turns?
Right, right. Those are like the wild cards of the market.
Okay.
Those sudden sharp reversals, they can happen out of nowhere.
Yeah.
They're pretty rare. But if you're on the right side of the trade,
Yeah.
it can be very profitable.
Yeah.
The key is recognizing the signs of a potential V-turn and being ready to move quickly.
So be quick on your feet. Okay, it seems like we've covered a lot here, from those basic phases and events to some of these more advanced concepts. But, what about the elephant in the room, the modern trading ecosystem? Things have changed a lot since Wyckoff's time.
You're absolutely right. We've got electronic markets, high-frequency trading, dark pools. It's a whole new world out there.
So do Wyckoff's principles still hold up in this crazy environment?
It's a valid question. And the book does hint at some of the challenges. For example, the volume that we see on exchanges, it might not be the true volume.
Oh, really? Why not?
Well, a lot of trading now happens off exchange in those dark pools.
Right, right.
So it can be harder to really gauge supply and demand.
So the data we're seeing might be skewed.
Yeah.
How do we adapt Wyckoff to this new reality? I know the book mentioned using some modern tools like order flow.
Order flow, yeah, that's one way to approach it.
Yeah.
Order flow is kind of like looking behind the scenes and seeing those actual buy and sell orders as they're placed. It gives you a much clearer picture of who's really in control and whether there's real buying or selling pressure behind those price moves.
That sounds amazing, but isn't order flow data only available to, like those big institutions?
Not necessarily. There are tools and platforms out there now
Oh, really?
that give retail traders access to order flow data.
Okay.
It can be a bit pricey, though.
Right.
But if you're really serious about trading with Wyckoff in today's market, it's something to look into.
Order flow, check. What about this volume profile thing that the book mentioned?
So volume profile is another great tool. It can help you pinpoint those key support and resistance levels based on volume.
Okay.
Think of it like a histogram. It shows you where most of the trading activity happened at different price levels.
So it's kind of like a heat map.
Yeah, like a heat map of the action.
Does it tie into those specific Wyckoff events or phases?
It can. You might see a high volume node on the volume profile that matches up with, say, a Wyckoff spring or an upthrust. And that would confirm that, yeah, there was a shakeout.
So all these modern tools can work with Wyckoff to give us a deeper look at what's going on.
Right,
But
exactly.
it also sounds like it takes a lot of knowledge and skill to use them effectively.
It's a journey, for sure. But that's what makes trading so interesting.
Yeah.
There's always something new to learn, and the markets are constantly changing. But by combining these timeless principles like Wyckoff with those modern tools, you can really gain an edge.
You've definitely got me thinking. Now, the book also included some case studies.
Yes.
Where we can actually see these Wyckoff principles playing out in real markets.
So let's do it.
I'm ready for some real-world examples.
Yeah.
Let's see how it all comes together. All right, welcome back to the deep dive. Time to put this Wyckoff knowledge to the test.
Yeah, let's see some real-world examples.
Exactly, because it's one thing to understand the theory, but seeing it play out in actual markets...
Right. That's what really brings it to life. Yeah. So what's our first case study? What did the book highlight?
Okay, let's start with a familiar one. the S&P 500 index. The book actually shows a nice example
Okay.
of reaccumulation happening on the weekly chart.
S&P 500, that's a big one.
Yeah.
So walk us through it. How did those Wyckoff phases unfold?
All right, so we see phase A starting with a classic sign of what Wyckoff called buying exhaustion.
Buying exhaustion.
Remember, that's when you have an uptrend that kind of fizzles out, but you don't see a big volume spike with it. It suggests that the buying pressure is weakening.
Okay.
Then we see an automatic reaction followed by a secondary test. So that neatly wraps up phase A. The market's transitioning from an uptrend to that sideways range.
Okay, so the stage is set for reaccumulation. What happens in phase B?
So in phase B, we see this interesting back and forth between strength and weakness. We see an upthrust action,
Upthrust action.
where the price tests those highs of the range, but the volume isn't really there to support a breakout.
So that's a hint that maybe the big players are distributing shares. But then we see a series of higher lows forming within the range, and the overall volume, it actually decreases.
Decreasing volume. Wouldn't we expect to see more buying volume during accumulation?
That's a great point, and it shows one of the nuances of Wyckoff, right?
Mm-hmm.
Sometimes the lack of selling pressure is enough to push the price up.
Oh, interesting.
In this case, that decreasing volume, it suggests that the big players are quietly absorbing those shares that are offered, but they don't have to be aggressive about it.
So it's like a stealthy accumulation. They're trying to fly under the radar.
Exactly. They're playing the long game, they're accumulating a good price, and then boom, phase C. We see a shakeout, decent volume, testing those lows one last time, and then breakout.
So the trap is sprung. And it worked. The price broke out.
It did. We see what Wyckoff called a major sign of strength.
Yeah, okay.
As that price breaks out upwards really convincingly. And then we get that final confirmation with the last point of support.
Last point of support.
It's a pullback that tests that breakout level and it holds, signal that the buyers are in control.
It all fits together like a puzzle. What I find really interesting is the price starts trending up in phase E, but the volume is decreasing.
Yeah, that's a key takeaway. Even in a big index like the S&P 500 sometimes, just the absence of sellers is all it takes to fuel that uptrend.
So the buyers don't need to be super aggressive,
Right?
because there's not a lot of resistance. It all comes back to supply and demand.
At score, yeah.
It's amazing how Wyckoff helps us see these dynamics. What other case study did the book have?
Okay, let's switch gears completely. Let's look at Bitcoin.
Ooh, Bitcoin. Now that's a market where emotions run wild.
Yeah, and the chart shows a clear accumulation phase playing out.
Okay.
But there are some twists and turns along the way.
I bet. So walk me through those Wyckoff fireworks.
All right. We see phase B kicking off with a test of those lows. It kind of looks like it could be a spring, but the price doesn't break out right away. Instead, it forms this smaller range right in the middle of the larger structure.
So it's like a mini reaccumulation within the bigger accumulation phase. Wyckoff inception.
Exactly. And this is where understanding that context from those larger time frames is super important. We got to recognize that this smaller range, it's just a pause in the bigger picture. And then what finally triggers that breakout of the larger structure is a minor shakeout that happens within that smaller range.
So the shakeout happens on a smaller scale, but it has a big impact on the overall trend.
Yeah, like a ripple effect.
Yeah.
And the volume really confirms this. We see a major sign of strength. That volume's increasing as the price breaks out of both those ranges, the small one and the big one.
It's all connected. So even in a wild market like Bitcoin, we can still see these classic Wyckoff patterns. What about an example of distribution? Did the book have one?
Yeah, they did. They showed Inditex, the Spanish textile company. And this is a textbook case of distribution unfolding on the 2-hour chart.
So we're switching gears now from accumulation to distribution. How did those big players orchestrate a move down in this case?
All right, so we see the distribution phase starting with this climactic event, a buying climax.
Buying climax, okay.
The price spikes up, big volume. That's where those big players are probably unloading a lot of their shares. They're selling to those eager buyers who think the uptrend's going to keep going. But then, boom, automatic reaction kicks in. The price starts dropping. Change of character.
Change of character from uptrend to sideways, and that sets the stage for distribution.
Exactly. And notice how that upthrust after distribution, it happens on low volume. That tells us there's not a lot of real buying interest at those higher prices.
Right. The trap is set.
The trap is set. The price falls back into the range. It gets rejected at the highs one last time, forms the last point of supply.
Last point of supply, okay.
And then breaks down. Decisive move.
That final trap before the drop. And we even see a gap down in this case that really emphasizes the seller's strength.
Right, that gap down, that's a major sign of weakness. Confirms those sellers are in control. Downtrend has begun. The price keeps falling, making those lower lows, lower highs. And we see volume increasing on those down moves. That's more confirmation of that bearish momentum.
So we've seen how Wyckoff can help us spot both accumulation and distribution in different markets, different time frames. It's a really powerful tool. Any final thoughts on using this method in our own trading?
The key thing to remember is Wyckoff is a framework. It's not a rigid set of rules. Markets are dynamic. They're always changing. So we got to be flexible in our approach. Always watch that price action, the volume. Look for those Wyckoff signs, and don't be afraid to adjust your analysis as things develop.
Solid advice. And like the book highlighted, there's always more to learn.
Always.
We've just scratched the surface of Wyckoff. There are those more advanced concepts, those subtle nuances to master, and new tools to integrate.
It's a journey, right? That's what makes trading so fascinating. The more you learn, the more you see, the better equipped you are to handle whatever the market throws at you.
Well, you've definitely given us a lot to think about and a lot to explore. Thanks for joining us on this deep dive into Wyckoff.
My pleasure. Always happy to talk markets.
And to all our listeners out there, keep those charts clean and happy trading.